everybody, and welcome to another Pepperstone live session here, talking about simple strategies and how we can break down markets a little bit better. My name's Thomas Atkinson, and today we'll be covering everything from indices all the way through to cryptos, commodities, and of course currencies. And I always encourage people, if you are watching this either live, make sure to ask questions throughout if you can, because it's great to get that kind of question feedback loop when it comes to these trades and particular pairs. And also, if you're watching in replay, make sure to subscribe down below and make sure to also sign up so you get to access the live sessions, and then you can ask questions yourself. I hope everyone's been having a great week. We're driving this one his solo today. Tyrone was unable to make it, unfortunately, but basically we've been going through a little bit of a condensed market in terms of a few indices. So I thought it would be a good session for us to kind of do the range bound section. So talk about what happens when we're in a dull market, what this means for us, whether we should be looking even at the short side. All of these questions, we'll try to answer them today as best we can. So I hope everybody's had a great week since last time. Of course, some of the things we've been talking about doing very nicely. We've discussed silver, gold bullishness. Obviously, crypto had a pretty wild week since we last talked. And then we also have seen markets kind of driving up very, very slowly. So let's kick things off here by understanding pattern recognition on the higher timeframes. Also, Stuart shouting out, thank you very much. I hope you're going very well as well. Great to see you in the comments section. So yeah, first up, I just kind of want to talk about the distance that we just saw the markets move, because sometimes when you go to the higher time frame and you're starting to think about where are we going to find range-bound markets or slower markets, we have to look for the reasons that something might slow down or kind of change around a point. And what we can do with the higher time frames is we can start to analyze that and say, okay, well, we expect the market to move relatively strongly from, say, point A to point B, and then we expect it to kind of slow down as it gets closer to there. And what happens here with the flag, and this is the flag, by the way, is that we have an A distance, which is the low to the high. And then as that becomes the pole, and as we extrapolate, oh, excuse me, guys, hopefully you didn't hear that. I need to edit that one out. But basically, you can see here, as it breaks through, we get this length on the pole. So effectively, we have a very similar type of move. We go A, and then A would equal B, and we're getting very close to that now. So we'd have to expect some consolidation as we hit 80% to 100% of our expectation. And I think it's a really good point whenever you're using supply demand or support resistance or pattern recognition, or really any technique that kind of has some predictive power in terms of where is the market actually going to go, that we go for around 80 to 100%, and we say that could be where markets start to go a little bit more range bound. And it's a great tip to be able to do that when you see it, so that you can recognize when you might not want to be going for those massive rally style, wow, it's going to keep going. And then I'm sure a few of you have had this where it's just, the stop loss has been hit a few days later and you think, oh, I should have taken it up when it went to those points. So the first tip is whenever you have supplies on the left-hand side or demands, you've got support resistances, or you've got pattern recognition going to that next level, there's a more decent chance you're going to get that range-bound start market. All right, so when we then have done that, we can say, okay, so around here, we'd probably expect the market to start to slow down, and around here, we'd expect the market to kind of find those highs. So effectively, somewhere in here is where we're, really checking these markets out at this point. So why is this important? Well, of course, as you guys can see here, we have the market effectively becoming what we would call dull. All right. Now, does anyone know the adage about dull markets? So what a dull market is, firstly, is it's a market that's making just barely higher highs and just barely equal or higher lows. What do you generally not want to do in a dull market? A few of you got a comment coming in here, never short a dull market. That would be correct. You really don't want to be shorting those dull markets. And the main reason why is because if you short a dull market, what ends up happening is you effectively, when you're shorting these dull markets, you're going against the trend, which is up. So again, check your daily, check your monthly, check your weekly. If you did that on the S&P, just for example here, all of them are up. And if you tried to short against that, you're generally going to get more hurt. So if I thought that this 80% to 100% level was going to be range bound or was slower, I still would be more likely to actually take the buys than the sells. And that's because, as a few of you said, never short a dull market. And that is because there is inherently, in this case, bullishness. But if you had a dull short, then it would be bearishness. And you can see here the reactions are generally better. So what I love to do is you approach highs and you approach that 80 to 100% is if you see markets coming up, going down, making slightly higher high, coming down, making slightly higher high, coming down. If you see reactions like this, which is, of course, a bullish hammer candle, these, especially coming off support, they actually can be a little bit stronger than you think. And that's because most people will be trying to short. You put yourself in the perspective of most retail traders, most big traders even that aren't Wall Street or the big hedge funds. And what they're going to be looking at is they're going to say, okay, I've loaded up my RSI, I've loaded up my stochastic, I've loaded up my MACD, I've loaded up all these indicators, and they're all overbought. Okay, so they're all really expensive, they're all overbought, and it's not really worth me, therefore, getting involved in this in terms of I want to short it. I want to short it. It's overbought. I want to short it. Does anyone know the problem when you get an RSI overbought or a stochastic overbought? Can they continue to be overbought for a while, guys? Can that happen to you? And while I let you answer that question, what I'm generally looking for instead is looking for further rallies, but I'm being a bit smarter about it. So if I'm going to buy, let's say, off this hammer, then I'm going to say, okay, the chances are is that we'll just be able to make like a dull new high or just in this resistance. So really what that's going to be is it's going to be like a one-to-one trade. But when you still see strength, even near the end here, it is more likely that these will actually still be bullish because the overall trend is. Stuart says here, yes, they can if they continue to be overbought. They can continue to be overbought for quite a while. Absolutely. That's completely true. So we've got that dull market. We've got that kind of market moving up. And for now, it will be very difficult to go against it. Now, if you are going to go against a market like this, what you're generally wanting to do is use a mixture of indicators and a mixture of usually some form of pattern recognition. So let's say here you'd said, okay, this could be a little head and shoulders. You can see this here on the 4-hour. 62.80 breaks below. All of a sudden, you've got a market that could proof back into 6,200. You've got to be short and sharp. So if you do choose to take a short in a dull market, which I wouldn't usually go with, then you would want to be faster in and out of the market because generally speaking, it's still going to have a lot of that pent up demand. Now let's move over to something a little bit different because of course there are markets that are currently in consolidation. Let's consider here if we look at something like the Russell 2000. So the Russell 2000 has been coming in pretty strong, and I've got a fib here, but we'll get rid of that for a second. So again, we ask ourselves the question, what is actually the trend? Are we really range bound? We are at a level of supply. So that means for anyone that's been listening today, what generally would we have been starting to think about if we knew this was a level of supply? What would we expect to have happened over here to price as it went up? So remember, we can know that supply here, we can know that supply here, we can know that supply here, here, generally anywhere. That's right, it'll slow down. Around 80 to 100% of your expectation based on your charts, you're probably going to see a slowdown. And that's going to be because people will more than likely start taking profits. And that's going to be that early indicator that you may have a range-bound market style trade. So what does that make you do? It means that if you take, of course, the trend is up, up, and up. So if you're taking longs, you're going to be a bit more nimble with them. Instead of thinking that it's all going up here and it's going to be in the next level of, the next resistance everywhere, you might be saying, I'm going to take it just to the slightly higher highs. And what you might notice here about the US 2K is that's exactly what it's kind of done. You've got a level, it's bought up. You've got a level, still support. It's gone up. Again, hitting into those highs, and then at the moment it's trying to push back into even maybe a higher high. It may still come down, and it may do this again, but the trend is still up. So in these range-bound markets, you've got to ask yourself the question of how did it get into that range-bound, And when it does get in there, remember there's still a decent chance that it will continue to find quite a lot of strength in the general direction of trend. Let's have a look at the dollar, but you got to be more nimble. The dollar index might be a good example of this as well. So here is the dollar index. I'm pretty sure if we went to the monthly, you'll be able to recognize it was in a downward trend. Okay, everyone can say that. You go to the daily, it was in a downward trend. You go to, oh, sorry, that's the weekly. You go to the daily, it's in a downward trend. Now, why is that important? Well, it's important because as it forms, let's say it hits the target, and in this case, if you look out, where would we be targeting? Just here. So what would we expect the market to do as it approaches 80 to 100% of this level? We would expect the market to start to slow down, as a few of you mentioned in the comments then. So the reason why this is so important is if you expect it to slow down, then you can start to use range-bound strategies. Now, of course, which direction is going to be stronger? It's going to be that short direction. And the reason we've gone through this for the first 10, 12 minutes today is just to really demonstrate how markets generally will move towards these directions. When they get there, they're generally going to slow down. And it's up to you whether you really want to trade them as going in the direction of the prevailing most trend inside of a range. So of course, being more of an expectation that they'll actually just be from the let's say the pullbacks to the shorts and that's pretty much what they'll do. Or do you want to go counter trend and start trying to buy against that trend? Now, if you're going to use counter trend, you're going to have to be quite a lot more nimble. So remember, if you're going in the direction, you're generally still going to be better, even if it's a range. Whatever the direction came into the range, generally the aggression, in this case of the shorts, will be more than the bulls until the bulls have won. And how could we know the bulls have won? So let's say this US dollar, for example. At the moment, you'd have to say the bears are still more in control, the shorters are more in control. This is how the market is going right now. When could we say, okay, this may have changed? Remember, we're kind of trading in a range. A lot of people would argue this is a range. We've been sitting now for 2-3 weeks in this range. Anybody know? Generally, it would be when it reverses with the lightning bolt to the outside. Yeah, that's right. It would need to make a higher high. And that would have to be on at least a daily time frame. And the reason you want to use a daily or at least a decent structured time frame is because that's going to show you that flow is going off in the opposite direction. That is, you've actually got bigger players, bigger AIs, bigger algorithms, hedge funds, whoever else you want to say, and they are actually going in the opposite or the different direction. So what this does is it helps us kind of define that it would be better still, even with the rallies that you might expect, it would still be stronger to be generally on the short end. And you can actually see this because what's happened, the market's gone up, come into the supply, it's shorted off. It's come back to the supply, and don't get me wrong, this may go to a new low and then do this because that's a lot of the time the way it forms. But it's probably more than likely that even if it goes like this, that's still quite an aggressive short that's come off it. And what that can do for you as a trader or a day trader is it can give you a little bit more momentum, and it's always easier when a trade goes quickly into your direction of trend. So here we have the supply, tapped, decent short. So how do we do this short? How are we going to actually implement a potential short at 98.50 to 99 more often than not? Well, one of the ways we can do that is, of course, using a volume profile. And we can use the volume profile through the move to kind of figure out where are the biggest transactions. And what you might notice here, and for anyone that's wondering, I'm using dollar futures here. Now, the reason I'm using dollar futures is because they actually do have volume. You may notice that if you look at the US dollar index, a lot of the time it won't have volume. So this is how you get volume. So you can use your volume analysis. And what I'm using here is a fixed range volume profile. Okay. And basically the market's making a series of lower highs and lower lows. And as it's coming down, it's trading a lot through this range here. So it makes sense that this range is going to be where you probably want to be looking more at the shorts, even though it's at effectively where you probably thought the market would go originally, 96 95.50, which we've said many times on this show, that would be 100% of the expectation. And we are trading between 80% and 100% of that expectation. It's so normal for this to be a range-bound market. So because we've ascertained this now through this beginning, what we can then do is we can say, okay, well, if we do believe that this is usually where we're going to get these range-bound markets between 80 and 100% of the general left-hand side expectation, then what we can do is we can start to build out a bit of replication. So here's the most traded area, pretty nice. Here is the market coming up the first time, because remember, we would have already known this. 96 was the expectation, so we could have just done that. You can see all this area very, very heavily. And what it does is it comes up and it goes high, low, higher high, lower low, okay? Lower low. Now, you may think this is relatively simple, but actually that's incredibly important because that is effectively a change of trend on the 4 hour, the 2 hour, the 1 hour, and every other time frame in between, because it is a structural change. If we knew the trend was down, it's getting to between 80% and 100% of our expectation, then we've got to be more nimble if we take a trade like this, but it's still better to take it in the direction of the general trend down. You can see here that then it goes down to 96 and it would have been a pretty good trade. You could have executed a short there, put a stop loss above here or here, and it would have been okay. Now, do we just see the same kind of thing happening over here on the right-hand side here? It is pretty much the same thing. It comes back into this level, and what you're looking for is you're looking generally for a high, a low, a higher high, and a lower low, okay? And if that happens, which it does technically here, but I would have preferred this news wasn't there. So let's say it happened there. It would have been a pretty good little trade towards the short end. You can see the aggression is there, which is quite nice. So what this is doing is it's just basically keeping you a little bit more in the loop of being more on the direction of trend as it comes into the range-bound market. Now, how do most people define range-bound? They define it by, I would say, 2 touches each side. So that would be 1 touch, 1 touch. 2 touches, 2 touches. That would then confirm range-bound market. So as it's bouncing back up, you would say, okay, well, if it comes back to the top, I'd be looking more at shorts. If it comes back to the bottom, I'd be looking more at buys. And until it does the 1, 1, 2, 2, I generally don't like going against the trend that is prevailing into that move. And I think that's a really hot tip for you to look at today in this video and in this live stream, because if you do go with the counter trend, how many of you guys just see it hit a level and you say, that's it, I'm going to short it, or in this case, I'm going to long it because you know what, it's hit the level. I know that that's probably 100% of the expectation. I'm going to go with the buy. I've seen a little bit of strength, and then it goes up, and then it comes down, and it wipes out your low. It takes a stop loss, wipes out your low, goes up, maybe comes down a bit, and then floats off into the sun after doing that. That is because markets, especially when they've come in with a trend, they become range bound. That's at what we call an equilibrium level. And that's where they wait for their next big move. Now, that next big move could be in the direction of trend towards the short. Predominantly it will be. But it could also be, of course, against and back to the buy side. But until it usually does the 1, 1, 2, 2, it's very, very difficult to say that the market's usually going to be stopping here and going off in the opposite direction. A lot of the time, it will take a while to build a base. And that's pretty common. I mean, if you go through any particular position, when they're bottom off, they often do take a little bit of time, or they consolidate somewhere. So even down here with Ethereum, you can see that the market comes in, the market goes down, the market comes up, the market goes down, the market comes up, the market goes down, the market comes up. So what that is it's a lot of, you've got your kind of your 2, and then you kind of become range bound. And then eventually it goes off in the direction of the trend, which is predominantly what it will do. Then it goes down, then it keeps going down. There's not much range bound here, and then it range bounds. So it goes 1, 1, 1, 1, 2, comes up. So that's the 2 up here. It sits around the 2, could have gone down. Of course, it could have gone back down here and created a 3, and then it rallies through that point. So as that becomes range bound, that's when you know it's gone neutral. So when it goes neutral, you can start to bring out more of your your stochastics and your RSIs and your range bound style indicators. But what I like to do is I like to say until it does 1122, I'm usually not neutral on the position. So let's say over here, I might have been short, gone neutral. Okay. It went from neutral to bearish, bear, neutral. Okay. That's a good way of kind of seeing these range bound style markets. And I like to generally trade the trend, but if I do see a range bound, here's probably a better one. And I'm doing this so that you can see I'm just looking at the markets live. A lot of people like go and cherry pick and stuff. I'm just trying to show you here that it's not really about cherry picking. It's just about being able to spot these things. So there's the 2, there's the 2. Then we try to trade the 3, the 4, and you can see it starts getting tighter, which is pretty normal. And the reason it gets tighter, by the way, because what happens is people have recognized this range. So where do a lot of people take profit if they recognize a range? So here's the low, here's the high. Where do most people take the profit? If they short the high, where it actually is not a bad place. You might think, okay, you short for the best place to do is TP is on the low. Where do you guys think it might be? And this is why you often get this type of pattern starting to form. Maybe the aha moment will come through when you look at this chart. Here it says take profit around 80% of the range. Yeah, that's not bad. 80% is certainly quite good, but you wouldn't have known after 1122, these were actually pretty close to the highs and lows. That was almost the equal low, the equal low, the equal high, the equal high-ish. But you can notice, see, they're a little bit shorter in this case, especially on the buy end than the short. The short's really close to it. That was the trend coming in. What I generally find is that it can be actually right around 50%. And that's why often when you take these ranges, you're going to a lot of the time find that the most amount of transaction is going to be somewhere in the middle. So in this case, we've got a lot of transaction at the top and we've got a lot of transaction in the middle. So that's why when someone shorts here, they're taking profit here. When someone shorts here, they're taking profit here. They get a little bit more scared of going, further and further down. But if I was to guess, where is the easier short? Where is the easier trend? Notice that the shorts are all way easier than the buys. You guys see that? The fact that the shorts are actually at those type of peaks and the buys, not so easy to get into the buys, is it? But when it breaks out, you can say, okay, cool, that was neutral. Now it's bullish. Because remember, the markets build this type of position. And Jack's actually coming in here with a really cool comment, which he says is gold in a big range in the daily chart. You're not wrong, man. And why could that be? I can't share this chart, but I can tell you about it. So there's a Bank of America report, and that Bank of America report at the moment has the most crowded trades. Okay. So as of, I think, May, and this will come true because gold is the perfect one, as actually was for my range bound today. As of May, over 50% of all of the trades, all of the investments were actually, everyone was bullish. So it was the most crowded bullish trade, okay? There was tons and tons of bullish action going on, and that was one of the most bullish positions. As of June's reports, it went down from 50 down into about 40, and now it's at about 27, okay? So that means that we've effectively, in terms of there's 100% pie of all the most crowded trades, 50% of all the most crowded positions were all on gold. So it was incredibly bullish. But now that we're in July, it's only 27%. So all those bulls from 50% down to 27 in terms of the crowding factor, they've reduced or removed their position. And that's because it has hit a target. And you might be not surprised that that target is based on a 80% to 100% system. So it's pretty cool how you can kind of see this, and you'll see it in a moment. But just note here that the direction coming in was short. The shorts were all easier to get into than the longs. The longs would have been super tough because you would have had to have instantly recognized that this middling point was where you wanted to take buys. And I think that would have been scary. Okay. And it would have been risky, frankly, because the risk reward's not good. Your stops have to be under here. When you take the short, your stop just has to be above here. See how the risk reward is so much better? And I've got stuff all over the screen, but does everyone see that? You know what I'm getting at here? Can you see? Does anyone realize like where they maybe have been going wrong a little bit, possibly in their trading style? You can see here, look at that, 2-to-1 trades. That's 2-to-1 because you literally only have to have your stop loss above here. You know, why do I have to have any more? Trend was down. I recognize potentially this was a range bounding market because I did the 1-1-2-2. Funnily enough, it makes a lot of sense because over here we've got a demand or a support level. You can claim both because, of course, they're different techniques, I understand, but we'll just call it that. I would use this as demand. This would be the demand. This would be 80%. This would be 100%. Notice that the market breaks that level. And the reason it does that is because building the algorithms and the biggest players in the markets, they build their position over time. They have to trade very large positions, and it takes a while to get the liquidity and the volume coming through. Now, Jack has a great question, so let's go on over to gold. And we'll use this as our example here for today for the learning experience. And effectively, you're completely right, Jack. It's been in a range-bound market. Now, I've actually taken, what I've done here is I've taken a little bit of an idea of pennants. So pennants are a pattern. Remember, I use higher time frames to define where I think a market might be going to. So if you have a look here, there's a pennant. And when you're taking a pennant trade, usually what you're doing is you're taking the pole length and you're extrapolating that out from the break, okay? So that would be 100% here, 80-ish% is probably around 3,200. So what have we been doing? Crowded trade, as we explained before. Crowded trade turns into range-bound market. Or in my estimate, it is a pit or a pullback in time. Now, here's a question for you guys. Should you have been taking longs predominantly in this range-bound market or shorts? What would you do now if you were thinking about it a little bit differently? And what this will probably start to do is it'll probably start to get you not trading as badly against the thing. Because you might come into this initially and say, that is super overbought, super ridiculous. I know it's overpriced. You don't know anything. I don't know anything. We don't know anything. Come on. Like, we do not know it's overpriced. How are you going to take all of the things that go into gold price, central bank purchases, geopolitical tensions, and all of these other things and put them together into a price? I doubt that you're like an Einstein level doing that. I'm not saying you're not smart. I'm just saying it's very difficult to do it. So you would probably be more on the long side. Silvio says here long. A few of you other guys are saying here predominantly long because the daily, weekly, monthlies are bullish. That's right. So if we went in and expected that as being a range, then we could say, okay, well, we've got here kind of a low level, a high level. We've hit one, we've hit one, we've hit two, we've hit two, and then we kind of go into that range. So we see here it goes up. The buy is quite nice because if we did buy here, then it goes right into the tops. But notice the sell, because it's against the trend, goes to what level, guys, of the range? What level did it go to? It went to around 50% of the middle, okay? And that's because people aren't that keen on the shorts. But a lot of retail traders are going to say, okay, I'm going to sell here, I'm taking profit here, and then they get greedy as it comes down here, and they think, oh, yes, it's going to keep going, and so on and so forth. So it's not really that good to do that. And while there weren't that many excellent buys in here, there were quite a few that were replicable. There was one in here that was pretty good recently. There's been a good one over here as well and a good one here. And targets could have been set up here. And now it looks like it's trying to break to the upside. But again, buying was stronger than selling. And that's because, and that's just, for a lot of people, it's unfortunate. Now they do the wrong thing. But if it had broken through here, then we would say, okay, we were neutral. Now we are more bearish. And then you would just have to start going into the direction of being more bearish. And you'll find that this stops you counter trending. And that's all I'm really trying to get at here. I know we're talking range bound, but I'm trying to also to get you to stop counter trending because you've probably noticed if you've been on a few things and you've been going against those things, especially in the last 12 months, 18 months, it's been pretty painful to be, against it. So that's been kind of nasty. So the other thing that we would do is, because this is another pennant, if this market did break out, and I'm not saying that you should go buy gold and, oh my goodness, it's going here. We don't know that. But in terms of where our expectations of range bound in the future could be, it could be between here and here. So we could then come in with a range bound strategy as gold hits into this and does the 1-1-2-2 kind of thing and start saying, okay, well, I'd like to be more bullish than bearish, even though it would just be like anything. Could be like euro, could be odd, could be anything. And that's because, remember, for a market to stop being bullish in this case, it needs to consolidate. And the reason it needs to consolidate is because it needs to get rid of the volume. So big traders need to be able to sell their positions into us and into other people that are less informed. And that's why you get these range-bound markets. So, of course, it's not the traditional range-bound strat, but I think if you're going to start thinking about markets a little bit differently, you've got to think two simple strategies would be the direction that came into the range-bound usually is stronger. The 50%, which is in the middle of the range, is a really good target, generally speaking. So remember, the way we went into the range is usually the better way, and then 50%. And the other thing that I would be looking at is, of course, when you're looking at any market, if you have a proof, which is generally a technical proof, whether that be a flag, a pennant, a supply, or a demand, as it approaches 80% of your expectation, if you are good at technical analysis and you can figure this out, then you generally will be looking for that ranging market. So guys, that probably brings us to the end of today's session where we go through these things. I hope it was kind of helpful. Was that helpful to everyone in the chat? Did you pull something out of it? Let us know. It's always good to note that stuff. In terms of general markets at the moment, you can see a lot of these trends have continued on so far. Obviously, the dollar's at a level of demand or support, so it's kind of consolidating, but the trend still was down coming into it. We've got crypto breaking out across the board, so obviously that's already been the trend on the upside, and you'll notice that as it went range bound, there's the supply. It sat there for a while. The buys were stronger. Now, this was a nasty one. This was a sneaky one. But if you go to a higher time frame, what's it look like? Looks like a bullish hammer. So, yeah, I mean, generally speaking, it's always better in range-bound markets to be going into the predominant trend that's come into it. So that's been really good. Silvio says good. Stuart says it's good. Quite a few of you others enjoyed it, so that was cool. So it was really good. Really helps me take out the emotion of trading. Trading's not really, I mean, emotion is the enemy. I always say the same thing. If you really want the number one word in most things in life, it's temperament. Okay? Temperament. That basically means can you kind of make sure that you look after your emotions and that you are able to not have effectively emotions in trading and investing and all these things. Because if you feel extreme greed or extreme fear, which we all do mostly, if you can't bring yourself back into here, you're generally going to make poor decisions. And when that happens, you've got to start thinking about, okay, how am I going to overcome this? What types of things could I do? Could I trade smaller positions until I build enough odds on favorite so that I can say, okay, well, it's just a mechanical thing. But I wrote a quote today over on my LinkedIn, and I said that alpha is usually created through being able to ruthlessly do the same thing time and time again when you have a system. And that basically means that you don't really feel the news. You don't feel any of those things. It comes back to patience, react, don't predict. And if it's in the press, it's in the price. I hope that was helpful, guys. Trish says really good. That's just what I need. Thanks, Tom. No worries, Trish. And I look forward to seeing you guys next week for another session where we'll be talking about live markets and obviously going through our thoughts on them as well. So really good. Make sure to subscribe down below if you're watching in a video, and we look forward to seeing you then. Bye, guys. Catch you again next week.